Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 11th of September 2024, and today is an important day for investors. Why? Because CPI, yes, inflation data is being announced by the Federal Reserve's FOMC this afternoon. Now, whatever those figures reveal will, to a large extent, dictate what equity markets, cryptocurrency markets, precious metal markets will do over the coming days, if not the coming weeks. Yesterday, we published a video. In fact, we published two under slightly separate headings, basically highlighting why gold could reach all-time highs this week. And if for any reason it doesn't happen this week, almost certainly is likely to happen next week. We've placed a link to those videos in the description box and comment section below. Today, we're going to talk briefly about the effect that interest rates could have on precious metal prices and why, regardless of what the FOMC does on interest rates, the effect could be very different to that which we're all expecting. So without further ado, let's take a look. Now I'm going to read an article to you from Reuters published today, and it puts forward a very interesting case as to the motivation the Fed may have to cut rates either aggressively or alternatively not to do that, but to reduce them gradually. We'll comment right at the end, stating why we believe the latter course of action is the one that they will take. This article is a few minutes long. Please bear with it because it highlights some interesting arguments that many people do not even consider, and many investors actually forget to consider when making their investment decisions. So let's look at that article. Blunt interest rates pose questions about Fed easing by Mike Dolan, September the 11th. If steep interest rate hikes fail to slow the US economy much in recent years, it is reasonable to ask whether their reversal will prove as toothless in a downturn. One of the puzzles of the past 2 years has been how 5 percentage points of tightening by the Federal Reserve between March 2022 and July 2023 had so little effect on the overall economy. Despite the borrowing squeeze, US real GDP has clocked annualized growth rates in excess of 2% in 7 of the 8 quarters since the middle of 2022, and is on course to add to that tally in the 3 months through the end of September. And for all its seasonal wobbles, the stock market is close to record highs. This suggests that the economy has become increasingly desensitized to changes in short-term borrowing costs. If that is the case, then policymakers should be anxious that any slowdown from here, or even a cyclical recession, might also be inured to monetary policy easing. Several theories about this resilience to high interest rates abound. The peculiarity of the COVID-19 pandemic years, including the ample household savings and government spending present before the tightening. The high level of fixed-rate debt in the United States, most notably mortgages, and elevated aggregate corporate cash levels that more than offset the hit that small firms took from the increase in debt servicing costs. The last of the three is perhaps the most remarkable. Net interest payments made by US firms as a share of GDP were halved during the tightening cycle, according to a recent IMF, International Monetary Fund, report. Other research shows US firms' net interest payments as a share of cash flow have also fallen since 2022 to their lowest level in almost 70 years. So what of the implications? Interest rates are clearly set to come back down, with the Fed widely expected to start its easing next week. But given the limited economic impact of rates on the way up, some analysts have argued the US central bank might need to push rates extremely low to stimulate the economy if a recession does indeed unfold. Others may argue that the impact of high rates has just been delayed, and that the lagged effect over the past 2 years is evident in the erosion of cash levels on some household and corporate balance sheets. But corporate borrowers are having little trouble rolling over their debt, even if they have to refinance at higher rates. Last week saw 59 new debt sales totaling more than $81 billion, the fifth biggest weekly volume ever for investment-grade companies, according to IFR. Some investors think this complex picture should inject much more caution into the Fed's thinking than markets are currently pricing in. Yves Bonzen, the chief investment officer at Julius Baer, reckons uncertainty regarding the transmission of monetary policy to the private sector is very high. Uncertainty is very high, largely because, as he argues, interest rates rose primarily to rein in an income-driven rather than a debt-driven economic expansion. Quote, if the real economy's sensitivity to interest rates is unusually low, it's not clear how asset prices will react should the Fed meet market expectations and cut aggressively, unquote. Bonzen's main point is that Fed easing in the absence of recession may well stimulate already accelerating private sector credit growth, spur the housing market and related sectors, and even revive the rate-stricken leveraged buyout and private equity market. Quote, in that context, the Fed would be mindful to avoid an asset price boom and bust cycle, unquote, he said, adding the 0.75 percentage point rate cuts to start would be more than enough while the US central bank continues to assess things. Now, for BlackRock credit strategists Amanda Lynham and Dominique Bly, it all hinges on what you think the Fed is actually doing here. Is it easing to offset signs of looming recession, or just recalibrating now that inflation rates have moderated? If it's the former, then that could result in deep policy rate cuts, but could also see a near doubling of high-yield credit spreads amid fears of a downturn. On the other hand, the BlackRock strategists figure that if the Fed is just normalizing here, its terminal rate will likely end up much higher, around 3.5%, and credit spreads stay where they are. Whatever your take, it's clear that no one, including the Fed, can be completely sure how this story will unfold over the coming year. That means investors should expect more edgy months like the one we are in right now. We believe that the Fed does not think we are about to enter into recession, but at the same time is mindful of the fact that it will not take much to tip the US economy into a recession. At the same time, it does not want to repeat what happened during the COVID and furlough period, where certain asset prices skyrocketed only to fall back again immediately after. Ask anyone who purchased a Rolex watch or similar during that COVID period to find that their asset has collapsed a significant percentage since. In addition to that, house prices historically are high. And whilst every government would like to see house prices rise year on year, they only wish that to happen on a gradual basis. And therefore, to sharply reduce interest rates at this period of time would potentially, A, be unnecessary because the US is not in recession, despite the fact, fully admit this, a number of states are in a poor state, but overall economy not in a recession. And secondly, they do not wish to have the risk of an asset price bubble. As a result, it is our assessment, and if we're wrong, then we believe the Fed will be wrong. Yes, we're arrogant enough to say that, but it is our assessment that they will reduce interest rates by 0.25% next week and will attempt another quarter before the end of the year, but no more than that. Now, gold is currently trading at $2,524 and silver $28.82. We believe gold will reach all-time highs very, very shortly, and that's less than $20 from the current price. Longer term, many pundits are anticipating gold to reach $2,600. And that is more than achievable before 2024 is out. Thank you for listening. We'd appreciate it if you liked this video, you would give it a thumbs up, subscribe, press the bell sign, pop on over to Finances Do Matter. We're rejuvenating that channel very, very shortly. Make sure you've subscribed there. Have a great day. Let's watch these CPI figures this afternoon and let's see what happens to equity markets, crypto markets, and for us all, the precious metal markets as a result.